You are likely earning more dollars today than at any other point in your career. On paper, your income reached a personal record, yet the month-end balance tells a different story. The grocery bill, the utility costs, and the rent have scaled up alongside your raise, often moving faster than the numbers on your check. This creates the core contradiction of the 2026 economy, a high-volume paycheck that buys a lower volume of goods and services. To understand why these gains feel so hollow, we have to look at the mechanics of the currency itself. Inflation is effectively a drain on that income, eroding the real-world value of every dollar before it even hits your account. Most people view inflation as a rise in prices, but it is more accurate to view it as a weakening of the currency. The goods you buy stay the same, while the money used to measure them loses its reach. This side-by-side comparison shows a standard burger. 5 years ago, it required 5 units of currency. Today, that identical burger requires 8. The product didn't change, the dollar's purchasing power contracted. This shift applies to the pillars of every household budget. Since 2021, housing, energy, and groceries followed a synchronized upward trend, making daily life more expensive. When the measuring stick of the dollar shrinks across all these categories, the result is a direct hit to the standard of living for anyone relying on a cash-based salary. This devaluation stems from a chain reaction. It often begins with physical shortages, factory shutdowns, or logistics failures that limit the supply of goods. These shortages are frequently compounded by geopolitical tensions that drive up the global price of oil, making it more expensive to create and move everything from plastic to produce. Businesses facing these higher overheads protect their margins by passing the cost to the consumer. You see this reflected in the final retail price. This chart illustrates the math of a wealth deficit. If you receive a 3% annual raise, but the inflation rate stays at 4%, you are moving backward. You have more dollars, but less ability to pay for your life. The impact is severe for retirees. With flat incomes and rising costs, savings buy fewer essentials yearly, forcing difficult trade-offs. Younger workers feel a similar pressure. As rent increases and mortgage rates stay elevated, the path to owning property becomes more difficult to navigate, even with a rising salary. This illustrates why nominal wage growth doesn't always lead to financial progress. If currency devalues faster than the raise, real wealth stays out of reach. These economic conditions create a divide between those who rely on cash and those who own assets. Keeping large amounts of wealth in a standard savings account carries a specific risk. The value of those savings drops as the dollar's purchasing power falls. Historically, those with significant wealth move their capital into assets like stocks, real estate, or business equity. Because these assets represent ownership of productive parts of the economy, their price tends to adjust upward alongside inflation. This mechanism shifts wealth from those holding cash to those holding assets, making the choice of where to store your earnings a central factor in long-term financial health. This effect is often described as the silent tax. It reduces your purchasing power without requiring a single vote or a line on your tax return. In 2026, navigating this economic environment requires an understanding of how currency behaves over time. Financial stability depends on more than the number on a paycheck. It depends on the ability of those dollars to cover your future needs. By focusing on purchasing power and the role of assets, you can build a strategy to protect your wealth against the steady erosion of inflation.